Hello, everyone. This is Dave Allison of Alison Wealth Management, and I want to welcome you to our Q3 market review. We're going to be going through a pretty quick table of contents here, but if you want to read through this information, you can click the downloadable PDF to dive a little bit deeper. But again, the focus here is to keep things high level. The first thing that I want to start off with is just an overall summary of the stock market in Q3. As you can see, 4 arrows pointing down. It was certainly a volatile market in Q3, particularly the month of September. The overall U.S. stock market was down about 10 basis points or 0.10%, while international developed markets were down about 0.66%, and emerging markets certainly got hit the hardest at down almost 8%. Now, some of that came from the volatility through China as part of that emerging markets holding. And last but not least, global real estate slightly down. You can see on the inverse side, bonds were typically up for the third quarter. The U.S. bond market was just slightly up, as well as the global bond market. And I always like to put that into perspective. If you look at the column down below, you can see what the average quarterly returns are. So since 2001, the U.S. stock market has averaged about 2.4% per quarter, emerging markets about 2.9%, real estate about 2.5%. And then you can see the best quarter and the worst quarter really in the last 20 years. Of course, most of that was driven through the financial crisis of 2008, with the exception of international developed markets, which experienced its worst quarter through COVID, down about 23.3%. Now, if we look a little bit deeper over the 1, 5, and 10 years, you can see this different market indices still produced stellar returns. Over the 1 year, the U.S. market up about 31%, 5-year and 10-year historical returns averaging almost 16 to 17%. International about 26%, emerging markets about 18%. Again, we've seen slower growth in international and emerging markets over the last 10 years from 2010 to 2020. But interestingly enough, from 2000 to 2010, international and emerging markets typically outperformed the U.S. And so some experts and economists are calling for a reversion, that we might see international and emerging overtake U.S. over the next 10 years. In addition, you can see global real estate up about 31%. Again, another strong performer over the last 12 months. 5-year and 10-year, again, lacking the market, which real estate traditionally does. Real estate typically has a lower expected return than the broad-based stock market. You can see the 1 year was a challenge for bonds, as we are still in a rising interest rate environment. As interest rates rise, typically bond values fall, particularly longer duration fixed income, which is why we try to keep our portfolio pretty short on duration and high credit quality right now. Over 5 and 10 years, we experienced 2 to 3% returns, but again, that was in a traditionally falling interest rate environment. So certainly, as I know I've shared with many of you, we are not having a favorable outlook on bonds in terms of driving interest or yield, but they still fit for a volatility control when you're holding the right types of bonds. Over the last quarter, we certainly had a lot of headlines in the stock market, but as you can see, the stock market stayed pretty steady amongst these headlines. Some of those were, of course, in late June, early July. It was declared that the United States coronavirus recession had ended in April of 2020 officially, so it lasted 2 months, which is still hard to believe. And we continued to experience new highs in the stock market. 3 major U.S. stock indexes saw all-time highs towards the end of July. And then, of course, the tech-heavy NASDAQ closed above 15,000 for the first time towards the end of July. Over the course of the last year, we all know we've experienced a lot of headlines. But what I love to look at is in the upper right-hand corner, that long-term projection of the market. Over the last 20 years since 2020, you can see there's been a tremendous amount of noise in the stock market, right? Things that have impacted all of us, whether it was COVID or back looking at 2008 and 9, like the financial crisis. But $100 invested in 2000 would be worth close to $400 today if you didn't react to the headlines and really stuck to your investment principles. And so that's really important to note. When we look at the third quarter across the world, we saw that there was a varying degree of world asset classes. At the very top, the Dow Jones U.S. Select Real Estate Index led the way at producing a 1.25% positive return, followed by world small cap, excluding the United States, which we tend to have a little bit heavier exposure to, delivering a positive 0.72%, the S&P at 0.58, the Russell 1000 at 0.21, which are the 1,000 largest companies in the United States, all the way down through emerging markets at about negative 8%. So again, really shows the importance of diversification amongst world asset classes. In the United States, we saw large cap growth continue to lead the way, followed by overall large cap and then market wide in terms of about breaking even, a loss of 0.10%. In international developed, we saw a little bit different story where we saw small cap really lead the way, followed by growth, large cap, and value. And remember, this international developed space makes up about 30% of the world stock market today. Last but not least, the laggard of the quarter was emerging markets. It represents about 12% of the overall stock market. And from a broad equity diversification, it's our smallest exposure, obviously, because of market capitalization. And you can see small cap led the way in emerging, followed by value, large cap, and growth. This represents the different countries. I know most of the time we're looking at the United States, but you can see the United States was about the 10th or 11th best performing stock market. Austria, Japan, Portugal, Netherlands, Israel, Norway, New Zealand, Denmark, Ireland all outperformed the United States, followed by the United Kingdom. As you can see at the bottom of the list, China and Brazil, Pakistan, Korea really dragged down the emerging market space. And so again, we continue to look at a world of investment opportunity out there. Currency was mostly negative in developed markets. And again, in emerging markets, you can see some of the volatility amongst currency pricing against the US dollar. Real estate, again, had a positive quarter in the United States, but a negative quarter worldwide. And again, the worldwide real estate market is about 36%, as opposed to United States is about 64%. From a commodity standpoint, this is always interesting. We've seen a huge spike in natural gas over Q3, about 58%, followed by coffee, or cotton, coffee, aluminum, sugar, heating oil, and as you can see down at the bottom, silver, soybean, corn, all lagged and delivered negative returns. From a fixed income standpoint, we continued to see the yield curve rise from Q2 to Q3, just a slight increase there. And again, as interest rates rise, which is represented by the yield curve, the principal value of bonds tends to fall. Over global markets, we saw a similar story in the United Kingdom and in Canada and Australia. And again, in Japan, still more of a flattening yield curve, but it is rising towards the long duration, as well as in Germany. And last but not least, I just want to close this quarter out like I usually do with the overall impact of diversification. Again, risk and return are related, and as you tilt your portfolio more towards stocks or equities, you increase overall risk, but you also increase overall expected return. As you layer in more assets like fixed income or bonds, you lower the potential risk of the portfolio, but you also lower your expected return. You lower your volatility or the ups and downs that you might experience. And at the top chart, you can see that a 100% stock portfolio lost about 1% this quarter. But if you were in a 50-50 balanced portfolio, 50% stock, 50% bonds, it fell by about 0.44%. So you're controlling volatility through diversification. Down at the bottom, you can see all the way back to 1988, had you invested in a 100% stock portfolio, you'd have the highest expected return. But as you diversify to fixed income, you start to lower that expected return, but you also lower the opportunity for the downside. And so again, this is where we work with all of you in determining what the right mix of risk and diversification is to deliver the results in the market from a return perspective. If you have any questions, please feel free to reach out to me, and appreciate you jumping on our third quarter market review.